We are now together in a position to fully understand, by contrast with the above process of healthy capital accumulation, what happens if investments are financed not by prior genuine savings, but by a process of artificial credit expansion, orchestrated by fractional reserve banks and directed by the lender of last resort, or central bank. Unilateral credit expansion means that new loans are provided by banks and recorded on the asset side of their balance sheets against new demand deposits that are created out of thin air as a collateral for the new loans and are automatically recorded on the liability side of banks' balance sheets. So new money, or I should say better, new virtual money, because it only materializes in bank accounting book entries, is constantly created through this process of artificial credit expansion. And in fact, roughly only around 10% of the money supply of most important economies is in the form of cash, paper, banknotes, and coins, while the remaining 90% roughly of the money supply is this kind of virtual money that only exists as written entries in banks' accounting books. This is precisely what the Spanish scholastics termed over 400 years ago chirographis pecuniarum, written money or virtual money that only exists in writing in an accounting book. It is easy to understand why credit expansions are so tempting and popular, and the way in which they entirely corrupt the behavior of economic agents and deeply demoralize society at all levels. To begin with, entrepreneurs are usually very happy with expansions of credit because they make it seem as if any investment project, no matter how crazy it would appear in other situations, could easily get financing at very low interest rates. The money created through credit expansion is used by entrepreneurs to demand factors of production, which they employ mainly in capital goods industries, more distant from consumption. As the process has not been triggered by an increase in savings, no productive resources are liberated from consumer industries, and the prices of commodities, factors of production, capital goods, and the securities that represent them in the stock market tend to grow substantially and create a market bubble. Everyone is happy, especially because it appears it would be possible to increase one's wealth very easily without any sacrifice in the form of prior saving and honest, hard individual work. The so-called virtuous circle of the new economy, in which recessions seem to have been avoided forever, cheats all economic agents. Investors are very happy, looking at the stock market quotes that grow day after day. Consumer goods industries are able to sell everything they carry to the market at ever-increasing prices. Restaurants are always full, with long waiting lists just to get a table. Workers and the unions see how desperately entrepreneurs demand their services in an environment of full employment, wage increases, and immigration. Political leaders benefit from what appears to be an exceptionally good economic and social climate that they invariably sell to the electorate as the direct result of their leadership and good economic policies. State budget bureaucrats are astonished to find that every year public income increases at double-digit figures, particularly the proceeds from value-added tax, which, though in the end is paid by the final consumer, is advanced by the entrepreneurs of the earlier stages, newly created and artificially financed by credit expansion. But we now may ask ourselves the following: how long can this party last? How long can there continue to be a huge discoordination between the behavior of consumers who do not wish to increase their savings and that of investors who continually increase their investment, financed by banks' artificial creation of virtual money and not by citizens' prior genuine savings? How long can this illusion that everybody can get whatever he wants without any sacrifice last? The unhampered market is a very dynamically efficient process, and this is precisely what I try to demonstrate in this book recently published by Routledge, entitled the theory of dynamic efficiency. Sooner or later, it inevitably discovers and tries to correct the huge errors committed. 6 spontaneous microeconomic reactions always occur to halt and revert the negative effects of the bubble years financed by artificial bank credit expansion. In my book on money, bank credit and economic cycles, I study in detail the 6 spontaneous and inevitable microeconomic causes of the reversal of the artificial boom that the aggression of bank credit expansion invariably triggers in the market. Let us summarize these 6 factors very briefly. The first reaction is the rise in the price of the original means of production. This first rise in the price of the original means of production appears when these resources have not been liberated from consumer goods industries because savings have not increased, and the entrepreneurs of the different stages in the production process compete with each other in demanding the original means of production, labor, natural resources, with the newly created loans they have received from the banking system. Second effect, the subsequent rise in the price of consumer goods at an even quicker pace than that of the rise in the price of the factors of production. And this happens when time preference remains stable and the money created by banks reaches finally the pockets of consumers in an environment in which entrepreneurs are frantically trying to produce more for distant consumption and less for immediate consumption of all kinds of goods. And this also explains the third factor, which is the substantial relative increase in the accounting profits of companies closest to final consumption, especially compared with the profits of capital goods industries, which begin to stagnate when the costs rise more rapidly than the turnover. Fourth, the Ricardo effect, which exerts now an impact which is exactly the opposite of the one it exerted when there was an increase in voluntary saving. Now, the relative rise in the prices of consumer goods or of consumer industries turnover in an environment of increased productivity, with respect to the increase in original factor income, begins to drive down real wages, motivating entrepreneurs to substitute cheaper labor for machinery, which lessens the demand for capital goods and further reduces the profits of companies operating in the stages farthest from consumption. Fifth effect is the increase in the loan rate of interest, even exceeding pre-credit expansion levels. And this happens when the pace of credit expansion stops accelerating, something that sooner or later always occurs. Interest rates significantly increase due to the higher purchasing power and risk premiums demanded by the lenders. Furthermore, entrepreneurs involved in malinvestment start a fight to the death to obtain additional financing to try to complete their investment projects. And Hayek explained all that in an article entitled Investment That Raises the Demand for Capital, that I recommend to all of you. These 5 factors provoke the following 6 final combined effect. Companies which operate in the stages relatively more distant from consumption begin to discover they are incurring heavy accounting losses. These accounting losses, when compared with the relative profits generated in the stages closest to consumption, finally reveal beyond a doubt that serious entrepreneurial errors have been committed, and there is an urgent need to correct them by paralyzing and liquidating the investment projects mistakenly launched during the boom years. The financial crisis begins the moment the market, which again I have said is very dynamically efficient, discovers that the true market value of the loans granted by banks during the boom is only a fraction of what was originally thought. In other words, the market discovers that the value of bank assets is much lower than previously thought. And as bank liabilities, which are the deposits created during the boom, remain more or less constant, the market discovers that banks are in fact bankrupt. And were it not for the desperate action of the lender of last resort in bailing out the banks, the whole financial and monetary system would collapse. In any case, it is important to understand, very important, that the financial and banking crisis is not the cause of the economic recession, but one of its most important first symptoms. The economic recession begins when the market discovers that many investment projects launched during the boom years are not profitable. And then consumers demand liquidation of these malinvestments, which it is now discovered were planned to mature in a too distant future, considering the true wishes of consumers. The recession marks the beginning of the painful readjustment of the productive structure, which consists of withdrawing productive resources from the stages furthest from consumption and transferring them back to those closest to it. Both the financial crisis and the economic recession are always unavoidable once credit expansion has begun, because the market sooner or later discovers that investment projects financed by banks during the boom period were too ambitious due to a lack of the real saved resources that would be needed to complete them. In other words, bank credit expansion during the boom period encourages entrepreneurs to act as if savings had increased, when in fact this is not the case. A generalized error of economic calculation has been committed, and sooner or later it will be discovered and corrected spontaneously by the market. In fact, all the Hayekian theory of economic cycles is a particular case of the theory of the impossibility of economic calculation of the socialism discovered by Ludwig von Mises, which is also fully applicable to the current wrongly designed and heavily regulated banking system.